Actually, we think it's consistent with maybe 90, probably the high 80s in this quarter, but there's another quarter to come. And we just don't see demand growth being that spectacular. And we actually think that with Saudi Arabia likely to come back, Russia likely to come back in October, the increment there, plus in non-OPEC and OPEC countries, is going to change the stock draw of the third quarter into a stock build in the fourth quarter and weaker prices by the end of the year.
What about China? What are the demand signals telling you from China? And if the rebound has been delayed to the back end of the year, how supportive a factor could that be for the oil price, Ed?
We think it could be supportive at the margin. There are a lot of moving parts. Yes, the biggest gap year on year so far is jet fuel demand, and most of that's on the long-haul international side, where China has not rebounded to where it was pre-COVID. On the other hand, the efficiency gains on the use of jet aircraft has been fairly spectacular. So they're using a much more efficient fleet. And we don't think there's more than a couple 100,000 barrels a day of incremental demand growth on the China side with jet fuel. Diesel demand is actually down because there was a lot of switching between nat gas and diesel when nat gas prices were higher than diesel prices. And that's gone back to natural gas. We think there's a little bit of growth potential on the gasoline side. Most of the potential is really in petchems, and they need to do something there to create a better market conditions. We don't think whatever they're going to do in the property sector is going to do much for oil demand growth, but they could do more in the industrial sector. They're shying away from it. So we don't think there's going to be this huge incremental spurt in Chinese demand by the end of the year. We think most of that demand growth has already been there.
Ed, OPEC and OPEC Plus, what is the prudent path for them in terms of managing the market?
So I think the most prudent thing they did was the actions undertaken by particularly Saudi Arabia and some 8 other countries when they announced in April their cut for May to the end of the year, maybe extending it through next year. That was a purely defensive move. It was that moment where they saw that demand was outpacing supply by nothing, and that it was the supply side that was the problem, along with incremental demand that just wasn't there. So they took a very defensive measure to cut production in order to make sure that prices, which were then Brent in the low 70s, were not going to go to the mid to low 60s. They were afraid, unless they took defensive action, of their being in the kind of hole they were in 2020. They took a little bit more aggressive action. The Saudis did, mostly on their own at the June meeting, to make sure that there was going to be a stock draw. And in fact, we had not much of any stock draw during the first quarter or the second quarter. The stock draw really began in the end of the second quarter. It was not a full stock draw on land. On land stocks grew a bit in the month of June. It was oil in transit at sea that we started coming off. Sea's coming off. There are about 30 million barrels less at the end of the month than the beginning of the month. So yeah, 1 million barrels a day on the oil in the water. And then finally, the cuts have made a difference in July, and the market has responded. And the market has responded where we thought the market would go to, in the kind of mid $80 range.